Well, yesterday, December gold futures traded above 4,000 for the first time ever. In fact, I think they closed above 4,000. And that became a pretty big news story, at least in the financial media. I listened to quite a bit of coverage of $4,000 gold, although technically gold was not at 4,000 yesterday because the December futures contract is the price to pay for gold that's not going to be delivered until December. The spot price is what I pay attention to for record. And yesterday, spot gold never quite made it to 4,000.
The recent surge in December gold futures marked a historic moment as prices traded above the $4,000 mark for the first time ever. This milestone quickly became the centerpiece of financial headlines, drawing widespread attention from investors and analysts alike. The symbolic crossing of $4,000 represents not only a psychological barrier, but also a reflection of growing uncertainty in the global economy. Many view it as a signal of inflationary pressures, currency devaluation, and a shift toward tangible assets. As Peter Schiff pointed out, this move underscores the ongoing loss of confidence in fiat currencies and central bank policies, which continue to fuel demand for safe haven investments like gold. However, as Peter Schiff emphasized in his commentary, it is crucial to distinguish between gold futures and the spot price. While the December futures contract surpassed $4,000, this figure reflects the price of gold set for future delivery, not its current market value. The spot price, the true measure of gold's present worth, remained slightly below that benchmark. Schiff's insight highlights how financial media can sometimes blur the distinction between futures speculation and actual market performance, leading investors to draw premature conclusions about the state of the gold market. This difference, though seemingly minor, plays a vital role in understanding how sentiment and expectation influence pricing trends. In essence, the excitement around $4,000 gold captures both economic anxiety and speculative enthusiasm. As Peter Schiff explained, such moments reveal deeper structural issues in monetary policy and fiscal management. Investors rushing into gold are responding not only to short-term price movements, but also to long-term fears of debt-driven instability and monetary debasement. Whether the spot price eventually follows futures above $4,000 remains to be seen, but the underlying message is clear. Confidence in paper money continues to erode, and gold's timeless appeal as a store of value remains as strong as ever. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Well, yesterday, December gold futures traded above 4,000 for the first time ever. In fact, I think they closed above 4,000. And that became a pretty big news story, at least in the financial media. I listened to quite a bit of coverage of $4,000 gold, although technically gold was not at 4,000 yesterday because the December futures contract is the price to pay for gold that's not going to be delivered until December. The spot price is what I pay attention to for record. And yesterday, spot gold never quite made it to 4,000. I think it came maybe $10 away at its peak, but it didn't get to 4,000. Well, that changed today because spot gold blew through 4,000. In fact, the intraday high, I believe, was 4,050 something. So we got more than $50 above 4,000. I think, gold was up better than $70 on the day at its high, although it closed off its high, maybe up about $50, $55. And as I'm recording this podcast live on Wednesday evening, gold's down another $23 in early Asian trading. So it's trading back below 4,020, but it's still holding above 4,000. Now, look, obviously, gold could go back below 4,000. I mean, that's not some kind of line that can't be crossed. And it's hard to say whether or not we're going to have a pullback from here. I mean, certainly the market is due for a pullback. I mean, we've come a long way. In fact, year to date, the price of gold is up 54%. I mean, that is a huge move. First of all, the year's not even over yet. We still have most of the fourth quarter left. But the last time gold was up this much in a calendar year was the 1970s. Now, that was a very significant time period. And by the way, silver rose today by an even greater percentage. It actually traded above $49.50 at the high. As of this morning, or right now, it's back below $49. I think it's trading around $48.80. But the intraday high, it got above $48.50. I mean, $49.50. So very, very close to $50, which is that key level for silver. But if you have to go back to the 1970s to find a year where gold was this good, and of course, it's not like gold had a bad year last year. Gold had a great year last year. It's just having an even better year this year. And of course, a 54% move from where gold was, dollar-wise, is a much bigger move. Think about the value of that move, because you're talking about a metal that's already, mid-2000s and moving up to 4,000. That's a big dollar value of the rise in what all the gold is worth. But if you've got to go back to the 1970s to find something like this, that probably means that what is happening now is likely as significant as what happened then. Now, what happened in the 1970s? You got to understand this, because it was 1971 that Nixon took us off the gold standard. It was supposed to be a temporary move, but it's now been better than 50 years, and we didn't go back on it. But that was a very significant development, because up until 1971, if central banks in Europe or anywhere held U.S. dollars in reserve, which they did, they knew that whenever they wanted to, they could take those U.S. dollars back to the U.S. government and exchange them for gold. It was a fixed rate. If you had $35, you had an ounce of gold. The Federal Reserve note was basically a receipt that paid the holder of that receipt an ounce of gold, right? So you were able to exchange your paper dollars for silver just by going to a bank and getting change, right? And you can get real money. You can get real dollars. You can get silver dollars, right? The Federal Reserve note was an IOU. In fact, if you read what it says on the Federal Reserve note, it doesn't say it's $1 or $5 or $10. It says pay to the bearer on demand, $10. The $10 is a weight of gold or silver, and so it's an IOU. So, but up until 1971, these foreign central banks who were holding U.S. dollars were really holding gold. They were just storing it in the U.S. in Fort Knox. They were storing their gold, and we gave them this IOU. But what they were able to do with that IOU was purchase U.S. Treasuries. So now they can earn interest on their gold, because their gold was, they still owned the gold. They could get it whenever they wanted, but in the meantime, they were able to earn interest. Now, when we went off the gold standard, that was a major disruption of the world monetary order, and it led to a major devaluation of the U.S. dollar, not only relative to other currencies like the Deutschmark or the Swiss franc or the Japanese yen or the pound sterling, but against gold.
The emergence of central bank digital currencies, CBDCs, integrated digital IDs, and programmable money poses a growing threat to personal and financial autonomy by enabling centralized control over spending, travel, and access to funds. In this environment, gold's ascent beyond $4,000 underscores the world's declining confidence in fiat currencies and rising anxiety over economic stability. Peter Schiff observed that while futures prices first surpassed the mark, the real turning point came when spot gold followed, signaling genuine market strength. With prices up 54% this year, the rally mirrors the inflation-driven surges of the 1970s, highlighting deep investor concern about debt, monetary debasement, and the sustainability of current fiscal policies. Drawing from history, Schiff linked today's developments to 1971, when President Nixon ended the dollar's convertibility into gold, dismantling the basis of sound money. Before that, each dollar represented a tangible store of value backed by gold or silver, preserving global trust in the monetary system. The detachment from gold initiated decades of inflation and declining currency credibility. Now, as digital financial control expands, investors are returning to physical assets like gold bars and silver coins as symbols of financial independence. Schiff argues that this renewed rush to tangible wealth reflects eroding faith in centralized finance and a desire for enduring, real-world value.
I think is an indication that something just as significant, and maybe even more so, is happening. That is what gold, being up 54% so far and smashing through $4,000 an ounce, that is what gold is saying. The problem is most people aren't listening to what gold is saying. And it's very similar to warnings in the past that went unheeded by people who never understood the problem. And I'm going to go into exactly what I think gold is foretelling after this quick commercial break. So don't go anywhere. We'll be right back. As a business owner, I know the challenge of navigating unpredictable markets, interest rates, and inflation. Now, recently, I think investors have finally started to buy not only gold, but silver. And that's why silver is finally catching up to gold and has made a bigger move, because for the years that central banks were the only buyers, they didn't care about silver. They didn't want silver. They only wanted gold. But now that retail investors and institutional investors are finally waking up to what the central bankers have known about for years, they're buying silver. And so this is the beginning of this next leg up. But what's more significant than that is what is going on behind the scenes. Why are these central banks doing this? And the other reason is the fiscal and monetary policy, because it's clear now to everybody. I mean, it should have been clear years ago when it was clear to me. But, I guess for these big things, foreign central banks, it takes a while for them to turn, like, turning a battleship, right? It takes, it's a slow maneuver. But seeing Donald Trump win the presidency, yet advocate for the abolishment of the debt ceiling and the big, beautiful bill, which took the excessive spending under Biden, much of which had to do with COVID and which was actually started under Trump, but which not only kept all that extra spending, but added to it and just blew already huge deficits up even more. Go off the dollar standard. Gold is going to replace the dollar as the world reserve. And then, of course, German companies, they don't need dollars anymore. Nobody needs dollars anymore. I mean, the only reason you would need dollars is to buy U.S. product. But we have a massive trade deficit. Our trade deficit is over $1 trillion a year. So the world has plenty of dollars if all they want to do is buy what we produce, because they've got a huge excess of dollars from that. And so those trade deficits can go away. But when the trade deficits go away, that means the products go away. That means Americans can't consume because the products are not going to be available. And the reason they're not going to be available is going to be because they're too expensive. And they're going to be too expensive because the dollar is going to collapse. And that is what gold is telling you. And it's interesting because I'm watching now the financial media discussing gold. I mean, really, for the first time. And I guess 4,000 is such a big number that, they kind of had to talk about, right? So the dollar would be rising against the euro. So that gold would be flat in dollars. The fact of the matter is gold is going up in all currencies because all currencies have an elevated inflation risk. But the risk in America, I think, is even greater given the potential loss of the reserve status. No other currency even has that status. So there's nothing to lose. Only America has something to lose. And what it has to lose is basically the pillar that's held up our entire phony economy. Without that reserve status, the whole, consumer-based economy that was built on top of that status comes collapsing down. So Cullo and his gang refuse to recognize that the rise in the price of gold has any significance with respect to any warnings about U.S. inflation or about the credit worthiness of the United States. But that is what's going on. That is the reason that this is happening. But now you've got more people on Wall Street who are coming out and saying you got to own gold. 10%, 15%, 20% of a portfolio in gold. Now, they used to say 0%. I put up a video on my X account yesterday from 10 years ago. And this is me on Futures Now on CNBC, and this guy, Scott Nations, who used to give me a lot of crap about gold. And there's a lot of footage with me and Scott Nations from back then. And gold's like 1,200. And I'm telling people to buy it. And he's just giving me crap because it's not 5,000 yet. And he said, hey, you said gold was going to 5,000. I said, yeah, I think it's going to 5,000. In fact, now I think it's going a lot higher than 5,000 because it took us so long to get here. But it's over 4,000. But they were just insulting me for recommending gold. They were accusing me of being irresponsible and reckless in promoting gold.
The The recent surge of gold beyond $4,000 and silver's rapid acceleration signal far more than speculative excitement. They mark a turning point in global trust. These metals are acting as financial barometers, reflecting growing uncertainty about debt-driven economies and unsustainable monetary policies. Central banks once dominated gold purchases while dismissing silver, yet now individual and institutional investors are joining in, recognizing both metals as safe havens. Could this renewed interest in tangible assets be the world's collective response to years of artificial monetary expansion and declining currency faith? If this trend persists, the implications could redefine global finance. Rising gold and silver prices may accelerate the weakening of the US dollar, shrink trade deficits, and make imports painfully expensive. As inflation deepens and purchasing power collapses, economies may be forced to rebuild around intrinsic value rather than printed promises. Ultimately, the upward march of precious metals isn't just a market event, it's a silent question to the world. What happens when faith in paper money finally runs out? If you found this information valuable, make sure to hit like and drop a comment below with your thoughts. Don't forget to subscribe and turn on notifications so you never miss the latest updates. Thanks for watching.